Welcome to Community Cocktails with Kimberly, hosted by Kimberly Woodard, a realtor for nearly 20 years with Ebby Halliday Realtors. Join her every first and third Wednesday of the month as she meets with the top community influencers to help you get to know the area you want to call home. Don't just love your home, love your community. And now, your host, Kimberly Woodard.
Welcome, viewers, to this episode of Community Cocktails with Kimberly. So this episode, we are going to talk about the hot topic of the housing market. Oh my goodness. So we have seen such changes in such a short period of time. And I have mortgage expert Gracie here with Gracie Morrow Mortgage. Welcome.
Thank you. It's good to be here.
Yes, I'm so excited to have you here. And let's talk a little first about you and, your experience in the mortgage industry.
Okay. Well, I've been doing mortgage for 10 years now. Really, it's my first official job.
Wow.
A lot of people wonder how I got into mortgage. I graduated from UT Dallas, finance and accounting majors.
Okay.
And wanted to be a CPA my entire life, but realized that that's not really something that I want to do. And my passion was more of a financial management.
Okay.
So I tried to be a financial advisor assistant right out of college,
Yeah.
but really wasn't qualified to do that.
Yeah.
I didn't really know what 401k and IRA was. And someone recommended mortgage, and I just have this passion for real estate as well, without even knowing that how fun the real estate world could be.
Yes.
So been doing this for 10 years.
Wow.
And love it every single day.
Well, and you've seen some changes. We've had changes over the last 10 years.
Yeah, for sure.
In this industry. So let's talk about what we're seeing now. So, we've had interest rates so low for, over the 6-7 years.
Yeah.
And then in this short period of time, we've had a little spike.
Yeah, a little. A lot of people might think, oh my gosh, my world is ending.
Yes.
I cannot handle this anymore.
Right.
Yeah.
But I think people were just so accustomed to these low rates. Whereas, I joke with people, and now I'm going to age myself. But when I was first started into the real estate market, I was writing contracts at 9.5%, 8.5%. And that was just what people were still buying.
Yeah.
And we were, selling, and, everything was moving. So
Yeah, I think that you're absolutely right on all the points you mentioned. So for first-time home buyer, or maybe not, my age is not really first-time home buyer anymore. I'm the later of the millennial generation. Yes. So people in my generation probably already purchased their first home, right? 10 years ago. So if I graduate from college 10 years ago, then we have bought 1 or 2 primary homes at this point. So 10 years ago, you're looking at 30-year interest rate, whether it's FHA or conventional, they're in the low 4%.
Yes.
And then you went up to a little bit 5%. We never ever reached the ceiling of 6 and 6.5%.
Yeah.
So for a lot of people my age, for a lot of people in this market have been somewhat active in real estate, and they just never seen anything on paper.
Correct.
Say 6%, 6.5%. But if you're asking people actually 10 or 20 years ago, like our parents' age, or someone that's a little bit older than the millennial generation, 8 to 10% is actually a really good rate.
Yeah.
So I was talking with my father-in-law yesterday, and they bought their first home about 40 years ago.
Yep.
And they said that they got owner financing at 9%. So I said, oh, why didn't you go to the bank? And he said, because owner financing was cheaper than the bank was offering me. Oh, and I said, what was the bank offering you? And he said 12%.
Wow.
So he actually said something very simple, but it's very fundamental. It's people's been spoiled.
Yes.
People absolutely been spoiled with a lower interest rate. And it doesn't mean that's not a good rate to own a house. Owning is always better than renting. And that's just the bottom line.
Right.
You can be paying 15%. That's still going to be better than renting.
Correct. And I agree with that, because you are developing equity into something. When you are renting, you are paying someone else's equity.
Yeah.
And so if you want, a financial investment, real estate is the way to go.
Yeah.
Our markets, we do see our market still strong. We've got so many companies coming into our Dallas-Fort Worth area. And so seeing that, where people are like, oh, we got the bubble that's going to burst and everything. Not necessarily when you have a healthy job market.
Absolutely.
And so I think that we always have that scare when things start to change. And then we start to see a little bit of a balance. And I think that's kind of where we're probably headed to, is that maybe we'll see a little bit of a balance out there. Maybe it will give an opportunity for some of those buyers that have been struggling on getting their offers and to actually be able to buy that home that they've been dreaming of, and maybe they've been trying for 6-8 months and losing in the multiple offers that now they actually will get to.
Yeah, I think the healthy market is really 3 different components. It's easier for the buyer to buy, it's easier for the seller to sell, and it's easier for the builder to build. So the new construction has always been almost like this water hose of, what is penetrating the market, what is providing the water and the air for us. So there's a lot of factors that will limit the construction. We have reports to show how many permits the new builders are pulling every year over year. That's related to the labor cost. That's related to the material cost. That's related to the land cost. So for the last 2 years, the labor cost has been, doubled. Right. So we did see a dip for new construction permits, but that's not going to stay very long. Right. Eventually, things are going to level up. And I feel like once the new construction level up, that's a very strong indicator of everyone is going to be able to find more opportunities in this market, because we got to learn how to coexist. Right. When seller is taking everything and the buyer is left with nothing. That just it's not healthy. No. It can't last for a long time.
No, and it's been a struggle. Even I see the struggle where I have a seller who is also going to be a buyer.
Oh, nice.
I'm like, well, I told you that it was great on this side, but not so great on this side.
I know, yeah.
I was like, it is a 2-for-1, but it's but it's funny to watch. Though, like I said, with this marketplace, I think we're going to start seeing some other options on financing that we haven't seen
or haven't thought about before or haven't heard of before.
Right. Yeah. Especially, to your point, was a lot of our people that are out there that are making their purchases, they haven't seen that in their time of purchase. Their parents probably have. I will say I have, because I'm a lot older. But that's okay.
We're only like a house or 2 houses away.
But we had different programs out there that helped that buyer, especially the buyer that. Let's talk about the buyer that average usually 3 to 5 years. So for that buyer, when we see interest rates rising, let's talk about some options that they may be not thinking of because they don't know about it.
Yeah, absolutely. So before I address some of the new programs, I want to say we just all need a refresher. Yeah. Because the program's been out for a long time. Yes. If you look at Fannie Mae and Freddie Mac guidelines, which is the 2 major agencies that want to use a very easy language for our audience to understand, because a lot of people say, who is Fannie Mae? Who is Freddie Mac? Are they related? Are they cousins? Are they brothers? So those are just 2 major mortgage companies that providing financing for all the mortgages in the U.S., right? So if you look at a history of Fannie and Freddie programs, there's a lot of options that they started using 40, 50 years ago when the interest rate were 12 to 10%. Yes. And when we're talking with home buyers now, and everyone is like, okay, well, this is great, but how long have you been using this? This is new. Because people are so afraid of, like, did you just design this program for this particular time
period
with this industry? Have you tested this before? Has anyone gone through this process before? Is my house going to get foreclosed on because no one have? Like we're not putting
we don't like newness. We don't like we don't like anything that's brand new because we're a little apprehensive about it.
Exactly. So no one wants to be the first one to try something.
Right.
I'm not saying no one, but majority of people don't want to. So a few things I'm going to share with your audience is something that's been going around for a long time. Yeah. People just haven't had a chance to use it or have a reason to use it. Right. The first one that's going to be very helpful is called a seller buy down. So the seller buy down program is for the seller to be able to contribute a certain amount. It's not the same as seller contribution. So this is a message to the seller. Yeah. You know, the listing agent, like Kimberly can be your listing agent, and she has to be very familiar with the program on top of the, steps that we need to go through, but it can work for both sellers and buyers. And essentially what we're doing is, let's just say the current interest rate is at 6.25.
Yes. And
there is a seller buy down program that will reduce your first 3 years of interest rate. The first year will reduce 3%. Oh, wow. So if the current interest rate is 6.25, the first year you're only paying 3.25.
Oh, wow.
The second year will reduce to 2%. So it's a 3-2-1. So it's a 3-year, like a staircase, right? Right. The second year will reduce by 2%. So the rate that you're paying is 4.25. Okay. The third year is 5.25. Okay. So you get to enjoy the really affordable payment, monthly payment for the first 3 years. Yes. And then my personal opinion is the reason that we're having a higher interest rate is because inflation. Yes. And I know there's a lot of other factors going around, but Fed has to increase interest rate when the inflation is just a little bit out of control at this point. Yes. And the reason for inflation is because we've been giving out so much free money in the last 2 years. Yep. So one way to control the inflation is to make your dollar go further. Yeah. And when your dollar can go further, the only way is to give less money out. And how do you give less money out on an institutional aspect is to charge a higher interest rate. Yep. So what we're doing is we're encouraging everyone to learn about the seller buy down options. And let's just say you have a buyer and said, I love the 3 years, but what happened after 3 years? Yeah. So the worst case scenario, the 4th year through the 30th year, you get that 6.25. So that's the biggest difference between this and adjustable mortgage. Okay. Adjustable mortgage, you don't have a guarantee. Okay. You might have an interest rate 10%, 12% on year 15 or 17, but this one have a ceiling. And then we also offer free refinance for the clients that are going through a seller buy down program. Okay. Because if there is opportunity for us in 3 years, 4 years, or 5 years to refinance to a lower rate, because you can see those are just come up and down, right? Yes. So then our client can enjoy the lower payment for the 3 years. Okay. Worst case scenario, they're paying 6.25 from year 4. Okay. And hopefully refinance to another 3% in 5 years. Yes. Yeah.
Well, that is a great program and something that, I haven't, because we've been in the interest rates, at this lower rate for so long. We've got to go back through, okay, what did we used to do? Right. And that's a fantastic program because that also, especially at this time where we did have that buyer who thought that they were looking at a price point of, this, I'll just use first time home buyer, these days, $500,000. Yeah. And that $500,000 home, based on now the new interest rates, is costing them a lot more. So they may think about things and be like, could I really afford the 500? Do I need to go down to more 450? Yeah. And because our prices are kind of, I would say, we are starting to see kind of that level out, but we're not seeing really that drop. Yeah. And so something like that could be something because we also are seeing with that adjustment, the home staying on the market a little longer, that could be an incentive for a seller to offer to that buyer to get their home sold.
Absolutely. And I think that's the the significant benefit for
Yes.
seller as well. So if the house is not moving,
Yes.
and if let's just use 500,000
Yes.
as example,
Yeah.
you can't just drop your purchase price or asking price by 5,000. That's not doing enough
No.
for the buyer.
Right.
So that could be a great marketing strategy for the sellers and
Yes.
say, you know, in the description we can say the seller is willing and able to participate in the seller buy down program. And the
Yes.
cost for the seller buy down is much lower than giving a seller contribution.
Yes.
So the seller can essentially walk away with higher proceeds, which
Very
they have
nice.
more to put down on their next home because, you know, we want to educate our buyers looking at the big picture, right? It is a purchase price, it's a long-term goal, it's a financial security. But a lot of buyers, doesn't matter if it's first time or second home, that they are looking at that monthly payment.
Yes.
You know, that is the first thing you got to look at. Can I handle this?
Yeah.
You know, on a
definitely.
monthly budget, can I afford this? And can I still go on vacation?
Right.
Can I still go out to have a fun, you know, time with my friends?
Yes.
So yeah, we think that we solve really the two problems for buyers and sellers. Mm-hmm.
And I think, you know, bringing that to the affordability, once they're looking at that and they're looking at what the current rents are, again, that's the other, is it, you know, the question always, is it better to wait to buy or buy now? You know, it is a good time still to buy. Because when you're looking at that mortgage payment that you're now going to develop equity versus that rental payment that is just, you might as well just take it, the money, and flush it down the toilet.
Yeah.
That's what I tell people.
Absolutely. Yeah, you're
So-
making someone else rich.
Yep. So, you know, definitely. So let's talk, I like that, the seller buy down. That's something that we, you know, we haven't heard of. Again, it's like going into our vault and pulling out the stuff that's like been dusty in there.
There's a little shoebox.
Yes.
Let me search.
Yes. But there are other, you know, options out there.
Yeah.
You talked about the ARM. Let's talk about the ARM, because I don't think, you know, people, especially over the last 10 years, have not even heard. They're like, what's an ARM?
Yeah.
What's that?
Yeah, definitely.
My ARM.
Yeah, and I don't know, you know, like it just, people are just like, how do you spell ARM?
Yeah.
When you're telling them, it's like, so I trained my team and said, don't say anything to our clients when they don't understand what you're talking about.
Right.
So our job is to actually remove all those professional lingo and then just explain a very, very simple language. So essentially what ARM is adjustable rate mortgage. And even it's adjustable, when you sign that mortgage document, you still are guaranteed for the first 3 years, 5 years, 7 years, and 10 years with a particular interest rate that the bank cannot change on you.
Yes.
The reason that wasn't popular is because the adjustable rate mortgage was about the same rate as a 30-year fixed rate.
Right.
So why would you want to take a risk of not knowing how long you want to stay in the house and when you have to do your adjustment? And then so most people go with the 15-year or 30-year fix.
Yeah.
But it's definitely a good option out there. It's, again, we've been doing this for a long time. And it's a program that designed 30, 40 years ago.
Right.
The number one question I get asked is, do I have a prepayment penalty on the ARM? No, you don't, because of the 30-year. And then the number two is, how do I calculate my monthly payment? Because it's only good for 3 years, it's only good for 5 years. So the way how they calculate is still amortized for 30 years.
Okay.
And then, so let's just say you sign up for a 5-year ARM, then we'll give you interest rate at 4%, for example. So the first 5 years is amortized for 30 years, and then you're doing your calculation based on a lower interest rate. Yeah.
Okay, gotcha.
Yeah.
Well, and again, we don't know what, you know, what could, you know, happen in 4 years. 4 years is a long time. You're developing equity into your home, and you can always look at refinancing. Of course, you know, if interest rates, you know, jump down to the, you know, below what you were at, or you know, you know, obviously there's always the risk, but there's a risk with everything.
Yeah.
Is the bottom line, is that whether even when you are buying a home and it is a low interest rate, you're taking a risk on, you know, the market.
Yeah.
So it's just what are you thinking of that risk? But at the end of the day, I always say, at least you're developing equity into that home.
Yeah.
So that's a positive. And, doing a program like that may be, something that you can afford it now. Maybe you get, your job is different, in 4 years or 5 years. And so it's a different, different mindset.
I hope that we're never going to be required to go back to the office to work. Because a lot of people who was looking to move outside the city and now all have to move back, which I don't think that's going to happen.
I think people have the work from home, which is, definitely had a impact on what people's housing needs have been, because it used to be that people just needed one office. Now they need two. And so they're having to maybe convert that secondary bedroom, if it had a one office, or figure out we've looked at converting different rooms. Media rooms are now office twos, and all that. But it has changed what people are looking for in a home these days, based on working from home.
Yeah, absolutely. And one of the really interesting stat that I want to share with your audience is, I think prior to COVID, most people would stay in their home for 3 to 5 years.
Yes.
And now that years have extended a little bit, so 4 to 7 years.
Yep.
When you're looking at stats like this, that just means that it doesn't matter how unique your situation is. For one reason or another, you need to make some modification on your mortgage. You need to make some modification to your lifestyle.
Yes.
You need to make some modification to your financial situation. So that includes moving to a different location, upsizing, downsizing, doing renovation, and maybe taking some equity out that you want to invest in other rental properties. So all those reasons, right, are the really potential cause for you not to have a 30-year mortgage.
Yep.
That's my whole point here is people feel like they're committed to a 30-year mortgage. They're committed to this house for 30 years.
Right.
I can only count for maybe one hand that I have a client that stay there for that long.
Yes, no. And I would say, right now with a lot of downsizers, I'm seeing a lot, they've been in there for, 18 to 20 years, but not much, much more, it's time to either downsize, reinvest, look at the other options out there, which is a great point.
Well, talking about investment, if anyone have a portfolio this year, we're down probably 20% of our portfolio or more.
Oh, wow.
Or more. Some of them are down 30%, 35%, depends on, you're comparing from 2020, COVID, the bottom line pricing for all the stocks or bonds or 10-year treasury. Real estate, on the other hand, have gone up 20 to 30%. So it's a great, going back to your point, it's still a great way. The fear in the marketplace is really compared to what we've been spoiled for the last 2 years. You're not going to find a great deal. In the beginning, we are doing multiple offers and overbidding, but real estate, nobody ever said real estate, you just hold for short term.
No.
You always hold for long term. 3 to 5 years, and you will get your return back. And it's just something that you can control a lot better than giving the money to your financial advisor and not knowing when that person's pulling the trigger on your portfolio. And it's your entire future of investment, retirement. And it has a very strong determination of when you can retire. Because if one person makes a mistake, that might require to work for 5 more years.
Yep, and we've seen that happen in lots of cases out there in history.
And when you own rental properties, when you own second homes, when you own primary home that you can leverage, you can literally call your own bank and say, I want to do this, I want to sell, I want to cash out. So there's a lot more flexibility for owning real estate.
Well, I love that, and I think that ends on a great note. This has been such a pleasure. And if anyone is looking to do anything, purchase a home and you're wanting to, find out some of these different programs, call Gracie. We have all her contact information. Or maybe you're thinking an investment property maybe in your future, and maybe you want to cash out from, you've got a home that you've been in for a while and take some money out of that to do that purchase, she can help you on all those. Well, thank you so much.
Absolutely.
This has been a pleasure. Let's cheers 2022. Phase 2 of the market.
We'll survive eventually.
Thanks for tuning in. If you'd like to contact Kimberly with your real estate needs, you can reach her at kimberlywoodard.ebby.com. We hope you enjoyed our guest this week, and remember, don't just love your home, love your community.